we're mixed right now. You've got the NASDAQ down by about 0.3%, but holding on to green for the Dow and the S&P 500. We got a busy week of big tech earnings here. Joining me now, we've got Jim Carroll, Ballast Rock Private Wealth Senior Wealth Advisor and Portfolio Manager. You say that the typical 60-40 portfolio allocation is just not working right now. So what should investors be doing instead?
Good morning, Brad. It's great to be with you. We are seeing the 60-40 behave somewhat the way it did in 2022, and that's not very useful for investors. We have not believed the 60-40 was the right strategic asset allocation for a long time. There's a lot more available than simple stocks and bonds these days, and we have been building portfolios using some combination of traditional assets and ETFs, but also including things like buffered ETFs that protect on the downside and private market vehicles like private credit to build what we think are more resilient portfolios.
And so with that in mind, what is perhaps a different type of, we like general numbers, right? That's why 60-40 perhaps has done well for a while in that balancing, but also it's easy to remember. So what is the different type of perhaps percentage positioning that investors should be keeping in mind?
It obviously varies by investor, right? Younger people can take on more long-term risk than some of our older, closer to retirement or in retirement clients. But we think, 50, 20, 50, 25, 25, or even a 60, 20, 20, something that gets less correlated investments in the portfolio. And that, again, could be a mix. We're taking some of our equity exposure and using buffered ETFs to give us protection on the downside while allowing participation in the upside, and then bringing in things like private equity secondaries, which we think have a tailwind, particularly with endowments like Harvard and Yale. Getting rid of some of their private equity exposure, that's going to wind up in the secondary markets, and we think there'll be some interesting opportunities.
Interesting. And so as we're thinking about what has transpired over the month of April, I mean, it has been a wild one for investors to track here. And in some of your notes here, really talking about Liberation Day and the tariff tantrum, a lot of investors are just trying to figure out what's next. Will there be, once we finally see some of the negotiations start to really solidify, any type of clarity around what a deal could look like on many different fronts for all of the countries that are impacted? And then additionally, how company fundamentals receive a little bit more clarity on the back half of that as well. What are you anticipating as the kind of what comes next critical moment here that investors are waiting for?
It's interesting because the tariff tantrum brought record-setting levels of volatility, both up and down. And just last week on Thursday, there was a lot of ink spilled in journalistic terms about a Zweig breadth thrust, which is a signal that perhaps the market has bottomed. And nothing would make us happier than to see stocks, go northeast from here. But we're concerned that the impact of the tariffs really hasn't been seen yet in earnings. There are a lot of signs to suggest that, if we're not in a recession, we're certainly going to see some recessionary outcomes from the tariffs. So we think it's a time to take a breath, not be overextended in the markets, let things play out a little while longer before we take any strong positions one direction or the other.
And so what is the kind of clarity point that investors should be keeping in mind, even as we're waiting for more details around that, and how they should be making sure that their portfolio doesn't have too much exposure to companies that could be hit hardest by some of the interim tariff negotiations?
It's interesting because one of the things that we've seen recently, and it really started before the tariff tantrum, was that global equities, Europe and certain parts of Asia, were beginning to outperform the US. So the other thing we're doing in our portfolios is shifting some of our equity exposure away from the US. It sounds counterintuitive. I talk to my friends in Europe and they say, you're crazy, you're out of your mind, things are terrible over here. But price is the ultimate arbiter, and we've seen outperformance in places like Europe, Latin America, Japan. So, we're also shifting some of the equity tilt outside the United States.
Jim, good to see you. Thanks so much for taking the time here with us today.
I appreciate it, Brad. Thank you.